I think this is going to be slightly good for savers, but certainly borrowers will see the difference here.
So the Bank of England this lunchtime raised interest rates from 0.1 to 0.25%. This is a major economic story, one which will impact households and firms across the country. So pin back your ears. In and of itself, this is a tiny interest rate rise from just 0.1% to 0.25%. Compare that with interest rates of 3, 5, even 10% or more back in the 80s, 90s and 2000s, and borrowing costs these days are still extremely low. Having said that, the Bank of England just became the first major central bank in the world to raise interest rates in response to this latest surge in inflation. It's a move that will be noticed around the world, not least by the mighty US central bank, the Federal Reserve, and other large central banks will likely follow. Here in the UK, the consumer price index was 5.1% higher in November than the same month in 2020. Inflation's now at a 10-year high and more than 2.5 times the Bank of England's 2% target. That November number was up on October, when inflation was 4.2%, which itself was higher than September's 3.1% inflation figure. So price pressures have been building here in the UK for some time and elsewhere. In the US, headline inflation just hit 6.8%. And on both sides of the Atlantic, measures of producer price inflation, the costs firms and factories pay for their inputs, are rising even more. Now, the Bank of England's just raised rates, even though the economy will likely be hit quite severely by these latest Plan B anti-COVID restrictions. Already, the hospitality industry, which employs around 1/10 of the workforce, is feeling the impact of these new measures. Yet, price pressures across the economy are huge, not least due to supply chain issues. Factory closures during lockdown, particularly in the Far East, have generated an acute shortage of microprocessors, for instance, which has reduced the supply of new cars, meaning the price of used cars is soaring, as any dealer will tell you. Energy prices are also sky high for both households and firms, given the spiralling cost of wholesale gas. Yet despite all that, with headline inflation so far above target, the Bank of England simply couldn't afford not to act today, as On the Money predicted earlier this week. To not raise interest rates when CPI inflation exceeds 5% would have given the impression the Bank of England has pretty much given up fighting price pressures, seriously damaging its credibility, and that would have caused inflation to rise even more. So now, after a decade and more of falling rates worldwide, in the aftermath of the 2008 financial crisis, the global interest rate trend, the cycle, just turned upwards after the Bank of England's Monetary Policy Committee voted 8-1 to raise rates, even if, pretty controversially, the same MPC economists voted 9-0 to maintain the bank's quantitative easing money printing programme. But from now on, borrowing's likely to get more expensive, while returns on saving will also gradually go up. And that's our On the Money question today. UK interest rates, how high could they go? As ever here on The Money, stand by for a grown-up conversation with people who really know their stuff. Joining me is Lee Wild, Head of Equity Strategy at the Interactive Investor. Good to see you, Lee. With me in the studio, not one but two On the Money regulars. It's Vicky Price, Chief Economic Advisor at the Centre for Economic and Business Research, former co-head of the Government Economic Service, and of course, the Money Magpie herself. It's Jasmine Birtles, talking about all things personal finance. Great to see you both. Let's go to you, Lee, first. You are a markets man, if you like. You work for an investment company. What I've noticed in the last few moments, really, since the Bank of England raised interest rates, is the pound has spiked against the dollar, which suggests the market didn't think this was coming. The market had convinced itself the bank was going to hold fire once more.
Yeah, absolutely, Liam. Not a great Christmas present. I think that it's a 50-50, I think, is the odds you would have got prior to today. I think with Omicron numbers hitting record highs and the COVID pandemic showing no signs of going away. I think people thought that maybe we wouldn't see an interest rate increase until February. Obviously, it's just only a small increase. I mean, that's the thing to bear in mind, I think. And I think probably people aren't anticipating a protracted rate tightening cycle at the moment.
Jasmine, straight to you for what it means for our purses and our wallets. It's a small interest rate rise, as I stressed at the top and as Lee Wild has just confirmed, but it still means the global interest rate cycle's turning.
Yeah, absolutely. It's a psychological and practical thing. As you say, America is already considering, they're saying that they're going to be putting rates up. So that'll be interesting. I'm sure the EU and various other Western banks will follow.
The European Central Bank, which runs the Eurozone. Absolutely, yeah.
Absolutely. So, already we've seen that the mortgage companies, and this happened last month, mortgage companies pulled their cheapest mortgages. It always happens. Every time you get a rate rise, the mortgages all go, oh, right, we'll get rid, we'll put our rates up immediately. Yeah. But the savings, back in 20...
the savings rates don't go up. I wonder why that is.
I can't imagine.
Why that is.
Oh, who would have thought? So, back in 2018, when we had a rate rise, only 1 in 10 banks actually finally put the rates up within, about a week. And then the others sort of very gradually. And hardly any put it up by the full amount. So, yeah, I think this is going to be slightly good for savers, but certainly borrowers will see the difference, yeah.
Vicky, what do you make of this? You're a well-known Bank of England watcher. I'm surprised, I must say, by not that rates went up. We predicted it here on The Money that the Bank of England couldn't afford not to raise rates, even if the rest of the market or some of the market didn't agree with us. But I'm surprised not by the rate rise, but the fact that quantitative easing is going to be maintained, so expanding the money supply, keeping monetary policy loose, while interest rates are going up, which is to tighten monetary policy. It doesn't seem to intellectually stack up to me.
Well, that's true, but of course there isn't an awful lot more quantitative easing that can take place. They've practically exhausted what there is, and I think there's only about 50 billion left.
Yeah, under the current
under
£895 billion programme.
But of course they might decide to spend a little bit more. But what we're seeing is that the other central banks are certainly moving to reduce their own quantitative easing. Remember, quantitative easing has been very significant in terms of keeping interest rates low generally, because of course you're looking at longer-term yields there. So if they're involved in the market and buying bonds in the secondary market, that keeps yields quite low, on which loads of mortgages and so on are based. And the interesting thing is that yields right now in the UK are still below 1%.
Let's just unpack that, Vicky, because I really want... A lot of our viewers are specialist people, and we've got Lee Wild here. Many investors are starting to watch the programme, as we know. But people sitting at home, this isn't their world. What you're saying is this Bank of England money printing, quantitative easing that we call it, a lot of that money has been used by the Bank of England to buy government bonds. And if it buys government bonds, it keeps the yield on those bonds, the interest rate the government must pay to borrow, almost artificially low, because the Bank of England is a customer buying the bonds rather than financial markets buying the bonds. Now, if quantitative easing is going to carry on for another few tens of billions, we know now, but when that quantitative easing stops altogether, what you're saying is that government borrowing costs might then spike upward.
Absolutely. For the moment, they're not spiking up. It seems, if anything, they've gone down a little bit, and that is, of course, because quantitative easing is carrying on. So what's happening, of course, is not that the bank is buying those bonds instead of financial institutions or others. It's financial institutions and others, buy them first, then the bank comes in and buys them back from them. And doing so, it increases the price and reduces the yield, because remember, these are fixed interest bonds. So the yield is really what you get by comparison to the price of that particular bond. So if the bond price going up, the yield, which is fixed in terms of interest rate, the yield goes down, and that's good news. It has been very important in funding, if you want to call it that, inverted commas, government spending, because without that stimulus that we've all seen, whether it's UK, US, the European Central Bank, we would not have had the recovery that we've seen in the economy.
Without QE, you're saying, Vicky, your argument, government spending wouldn't have been as high as it's been because governments wouldn't have been able to borrow so cheaply, and taxation might have been higher in order to meet those higher borrowing costs. We'll see what happens when QE ends. Let's go back to you, Lee. From a market perspective, I think we were all surprised. The market certainly took umbrage when the Bank of England didn't raise rates last month, but a lot of people in the markets figured that they wouldn't impose an interest rate rise just before Christmas, particularly once Omicron Plan B stipulations and regulations were announced by the government. What do you think it is that's made the Bank of England once again not trick, but certainly sidestep market expectations?
Well, I think they've seen the strength of the data, especially on the jobs market and growth today that we've seen. I think it's given them the confidence to go ahead and pull the trigger. It also gives market watchers confidence in the strength of the economy. If the Bank of England is prepared to go before Christmas, then that reflects well on that view of the local, the domestic economy at least. We saw a similar thing in the US last night. That new dot plot there, that sort of forecast for interest rate rises next year, and the markets responded positively. And we've seen, while we saw the FTSE 100, the FTSE 250 fall on the news today, we also saw some of the perhaps more vulnerable sectors, vulnerable stocks. Some of the house builder stocks fell on the news initially, one or two of the supermarkets and some other sectors, but bounced back very quickly. So I think there was that initial response where they thought this is bad news, but then it took some time to think again and have taken it more positively. Banks obviously have done it incredibly well, as one would expect.
Lee, that's very, very interesting. I've been thinking for some time, for months and even years, in fact, despite all the doom and gloom from financial analysts, if we raise rates, financial markets will collapse, yada, yada, yada. I've written many times that actually if you raise rates, wise heads in financial markets will think, this is the beginning of the end of a mad period. We're beginning the long trek back to normality, pre-2008 normality. What you're saying to me, and you've forgotten more about financial markets these days than I'll ever know, but what you're saying is that there are investors in the markets who are thinking, actually, if we're raising rates and the Bank of England's raising rates, it might mean that they really believe the economy is in a better place, it's stronger. So it's a psychological switch for all of us, really.
Yeah, we've gone through perhaps one of the biggest shocks that any stock market could experience. Obviously we had the Great Depression in the 30s, but the pandemic, no one could have forecast that, and the impact was significant. And what we saw was the government step in and bail the economy out, bail out vulnerable sectors, and bail out the taxpayers. It is those taxpayers who will eventually pay the bill. But yeah, it's the markets and many companies, although they were hit severely in the immediate aftermath, have recovered very strongly. And now we're seeing some of the major indices in the UK, which had lagged international peers. The domestic indices are now back to roughly where they were pre the pandemic. So I don't think anyone's forecasting interest rates back up at 6%, 7%, that sort of figure. And no one anticipates as I said earlier, prolonged interest rate hike cycle. Perhaps two or three, no more than that, and perhaps then a pause and see where we are. The economy does remain vulnerable, though, to the pandemic and various variants, which is yet unknown, which could derail the recovery.
Very interesting. Thanks a lot, Lee Wild, Head of Equity Strategy at the Interactive Investor. Nice Christmas tree too. Look forward to seeing you back on the show sometime. Vicky and Jasmine, you're going to stay with us. We're coming back later in the show. We're going to carry on this important discussion about interest rates, delving into how the change will affect savings, mortgages, and we'll be joined by a mortgage broker too later here on The Money. Your emails are flooding in on interest rates. Of course, it's a hugely important topic. We'll be reading out some of those messages after the break. Stay with us. You're on The Money.